Don Peebles is founder, chairman, and CEO of the Peebles Corporation. It's a privately held real estate and development company with a portfolio of multi-billion-dollar projects in most major metro areas, including New York, Miami, and L.A. Don, it's great to see you. And since the last time we spoke, it feels like the traction behind Miami just keeps growing. Before we dive into that, though, let's just talk overall about trends here. Are people coming back to the office?
Very slowly, and they're not going to come back full time. Most people that are coming back to work and working live are working part time, 3 days a week, 2 days a week. But I think that's a trend that will continue and go throughout the marketplace.
What does it mean for New York, for Manhattan especially? I mean, just as an example, because of its concentration in financial services, where this has been such a huge fight. You know, there's companies that have been early and really pushing for people to come back to the office. And maybe now, if things slow down a little bit, workers won't have as much of a choice and they'll have to.
Well, I think that one of the things is efficiency. If you look at law firms, for example, especially transactional law firms, they've had some of their best years ever these last 2 years in terms of billable hours because their lawyers are working as opposed to spending their time commuting. So we're seeing more and more firms recognize that they are more efficient and more businesses are more efficient with remote working put into the mix. And so I don't think that changes. I think that expands and people are settling down, and big law firms and major banks have accepted this change in how people are working. And what it means to New York is that businesses are going to suffer. I mean, the businesses that depend on a large influx of workers in the city every day, I think that will continue to have a negative effect on those businesses. And we're going to see, many of these smaller businesses, unfortunately, close. And many who have closed will not reopen. I think it's a good thing in terms of the residential market, though.
Yeah. And anecdotally, I mean, sometimes people joke in New Jersey about having a place in Manhattan for the weekend, but you wonder if it turns into more of a bedroom community in the long run. Let's talk about these office REITs, though. Are these leases, these are multi-year leases, and I wonder if they are, how long of a period of adjustment could we face in companies downsizing? And could that be offset by inflation, where higher leases take some of the sting out of those declines?
Well, I think that what happens on the residential side, for example, is rents are going to go up. So even though the cost of capital increases and cap rates increase, investors who own apartment buildings in most major cities around the country will continue to do well. I think the commercial office market, of course, is very different because there's just a flood of sublease space on the market right now. And that, along with increasing vacancies, I mean, New York City is essentially over 20% vacancy factor overall in terms of leasing, not necessarily occupancy. And occupancy is only about 40 some odd percent right now, mid 40s at best. And so what you're going to continue to see is more sublet space going to market, and that's going to depress rents even further.
Let's talk about Miami for a second. Is it in a bubble because of so much demand being driven by crypto?
Well, no, I don't think so, because I think that if you look at Miami, I mean, bubbles are created by artificial or short-term stimulus. And Miami is fundamentally very well equipped to compete against cities like New York, Chicago, and many other northeastern cities, Washington, D.C., for example, as well. And we saw that with King Griffin moving Citadel to Miami. He's moving out of Chicago, moving 1,000+ workers down to Miami. Miami has no state income tax. It's an extremely business-friendly environment. It's a right-to-work state. So even on my business on the construction side, unions do not have the same kind of impact that they do, say, in New York City. The quality of life in many regards is superior, certainly on a weather basis, and they don't have the same challenges of public safety. So they're fundamentally just so much better equipped to compete right now.
It's a little humid, so not everyone likes that heat. But I take your points. So since you know so much about the real estate market, Don, where would you have the individual investor put their money to work? Do you like the office REITs down 20%? Do you think they should steer clear of that and maybe look towards something more residential? Should they be involved with REITs at all? Or is this a time for maybe more individual property ownership or rent exposure? Where do you think has the most value right now?
Well, I would stay away from the office REITs. Investors understand that they are fundamentally challenged. I mean, any of the REITs like Vornado, SL Green that are heavily concentrated on office space in New York City are in tremendous trouble. So I would be looking as an individual investor at where I could buy apartment REITs who are investing in the Sun Belt area, and I think that's where you're going to see growth. And as an individual investor, I would still invest in South Florida overall and other parts of Florida, Tampa, Jacksonville. I'd certainly look at Nashville and throughout Texas, because Texas is doing very well quietly. So it's not the headline state that Miami and Florida in general is. So I would look at Texas as well. Arizona strong, and Las Vegas, Nevada has made a big comeback, especially in the housing market. And I think you'll see more of that. And the gaming business, and that's another place. If I were going to look to invest, I'd start looking at the gaming business again. And any REITs I would look at would be in the hospitality sector, especially those hotel REITs that are focused on leisure hotel ownerships.
Fast.